This screencast is focused on Autumn 16 question 1, particularly on a computational Wacc question. So again, we're going to look at the question 1, part A, for 13 marks, calculate the Wacc of WEFT based on the information above. So I will leave you to look at the other 7 marks, which are predominantly narrative in nature. So again, the Wacc question has been a common one in the compulsory question 1 or question 2 over the last number of years. So it's important you understand how to approach a Wacc question, and particularly you're comfortable with each of the types of source of finance and the associated computation element. So in this element, I'm assuming you've read down through the question. So you've given the tax rate, you're given information about dividends, and the first step always in a Wacc question is the number of sources. So in this case, we have 3 sources of finance. We have ordinary shares, and remember, ordinary shares encompass share capital and revenue reserves. That's another word for retained earnings. All of those 3 are the same thing. They're owned by the shareholders. So the first one is ordinary shares. The second one we have is the debenture loan. And the third one is the irredeemable bond. So we have 3 different sources of finance, and when we're doing our Wacc table, which is what we're going to do here, we need the market value and we need the cost. So they're the 2 things we're going to be looking at. So we put cost here. We need the cost of it and we need the market value. Let's just write this up bigger. So that's your first starting point, is what is the number of sources? In this case, we have 3 sources of finance. So you're essentially getting 13 marks now for getting these figures, 6 figures, a cost to capital for each of them, and a market value for each, and then getting the Wacc. So the Wacc will be a weighted average of those then. So what I typically tell students is go to the appendix and go for working ones, just the next page. We'll start off with the ordinary shares. So remember, you should have a summary study sheet done out. There's only a certain number of sources of finance that can be asked, and therefore you can practice then each of the sources of finance from past questions. Here we're looking for the market value of equity, and we're looking for the cost of equity. So we're told profits, we're told the tax rate, we're told they pay dividends of 100,000 and they retain profits of 206. So your profits are 306, the dividend is 100, and therefore retained is 206. Now, often that won't be given directly in the exam. What they might tell you is the profits for the year, and they'll say the payout ratio will be 100 divided by 306. So the payout ratio might be 32.7%. Or they could say the retention ratio is the amount you retain divided by the total. So what you know is the total still must come to 100%. So just bear in mind how they'll say that. Here they've given it directly. They might call that the payout ratio. They could call that the retention ratio. So regardless of which one you're given, you should be able to work back to what the dividend is. So we now know the dividends. We know the growth rate, G, is 10%. We're given in the question. It has net assets of 2.8 million. So those 2 debt finances, and we have ordinary share capital, share premium, and revenue reserves is also known as retained earnings. Now, to get the number of shares, which is a tricky one, just be careful. You have 40,000 share capital, but each share is worth 10 cents. So you have to divide by 0.1, meaning you're going to have 400,000 shares. So that's a tricky one. When your shares are not worth €1 each, in this case they're only worth 10 cents, you have 400,000 shares. 400,000 shares. We're going to need that when we get the market value. So we have a profit, we have a dividend. We can calculate then div per share. Your dividend per share is 100. So 100 divided by 400. Just be careful, that's 100,000. So just make sure you're dividing by the right one. It's 100,000 euros divided by 400,000 shares, which is 25 cents each. So your D0 there is 25 cents. We'll call that C0. Your D0 is 25 cents. Right, so we're building up. So we know we're looking at this. And we're coming down here, we're given that information, we're told WEFT is a competitor quoted on the stock exchange with a similar level of business and financial risk. its cost of equity is 13%, and it has a stable, i.e. no growth, dividend per share of 95 cents. You've been advised that the market value of WEF's shares should be based on the competitor share price, and however expects its shares to trade at 20% less. So it says to get the market price of WEF, you value the shares, you get the price of its competitor. And remember, this is testing your knowledge of the dividend discount model. So this is the formula that's given in your exam paper. We can see here, if you just open it up, the dividend discount or dividend valuation model with no growth here. We can say KE, if we're looking for the cost of equity, is the D1 next period's dividend over P0. So what we could also say here is we can rearrange it to say P0 equals div1 over KE. And we have both of those figures. So if we come back to here, we have the price to competitor is 95 cents, which is D1, because the dividend is the same each time, divided by 0.13. So it's a perpetuity with no growth is the cash flow, the dividend, over the discount rate. So their price is 7.3, and we're going to trade at 80% of that, because we're told we're going to trade at 20% less. So we're going to trade at the price of WEF is 5.85. 20% off. You're told that in the question. So the market value of the equity then, the market value of the ordinary shares is the number of shares, 400,000, times 5.85. So that was tricky, that you had to watch and you to remember how to use the dividend discount model. And we're going to use that to get the share price of WEF. So it's 2.338 million. Now you might round if you want. I'm just going to leave it whole. So slightly different the solution, but that's fine depending on rounding. So we're just going to say the market value there is 2.3, essentially 4 million. So that should be in the cost. So let's open up this. So we now have one market value. There's two ways to get in the cost of equity. Right? You should understand those from your little cheat sheet. You're either going to use CAPM, Capital Asset Pricing Model, or you're going to use the Dividend Valuation Model. Here we have the growth rate, we have the dividend, we have the price, so we're going to use this formula. The Dividend Valuation Model with growth. And it says the KE, so remember, don't be, often in Cap 1 the formulas will be given to you. So make sure you know how to use them. So we're told here to get the cost of equity with growth, we say it's the dividend times 0.25 times 1 plus the growth rate, which is 1.1, divided by the price, which is 5.85, and you add on your growth rate 0.1. So that's coming from that formula here. It's 0.25 times 1.1 divided by 5.85 plus your 0.1. So that's just a rearranging the dividend valuation model. Now if we come back down to that to get a solution, our cost of equity, put in the equals, is about 14.7%. About 14.7% is your cost of equity. Remember, there's two ways to get the cost of equity. You're either going to use the CAPM, Capital Asset Pricing Model. We don't have betas, we don't have risk-free rates here. We do have the inputs for the dividend valuation model. So therefore you have to decide which one to use. So we're using 14.7% there. And that's our first two figures out of 6 figures done. So you can build up, start with the easier ones if you wish, and work towards the harder ones. So we've dealt with the ordinary shares, that's working 1. Now we're going to do working 2. Now working 2, I'm going to do the easier one first. I'm going to do the irredeemable bond. When it's irredeemable, it's not going to be redeemed in the future. To get the cost of debt there, cost of an irredeemable bond will be the interest over the price times 1 minus t. Right, so you need to understand that. It's given to you in the solution. It is given anyway. See it here. Irredeemable debt, cost of debt. It's the interest times 1 minus t. So if we want to put that up just so in case people don't get confused. Interest times 1 minus t divided by the price. It's divided by the price, which is the capital D. So you see, sometimes students can be confused. They won't know what the notation means. So you need to understand the formula, not just hope for in the day you'll understand how to use it. So in this question, it's the price they're trading at par. So par is typically we take to be 100. So the price they're trading at par. There's no interest adjustment, so it's 100. The interest is based on 9%, so it's 9%. So the interest will be 9, which is 9% of 100. Let's put it here. 9% of 100. So your cost of debt then is 9 times 1 minus 15%, because we know the debt rate you're given is 15, and divide that by 100. So your cost of debt after tax. Why do we do after tax? Because interest on debt is tax deductible. Interest on debt is tax deductible, so 7.7%. So your cost of debt is 7.7. Your market value will be the same as its book value, 208. Why is that? Because remember, your loan, your irredeemable bond, is trading at par. So whatever way you want to do it, one way is 208, excuse me, divided by 100, multiplied by 100. It's still trading at par. So it's going to be its book value because it's trading at its core amount. So here you have 7.7% and you have 208,000. That's another 2 done. So you're gradually building it up. And the nice thing about a Wacc question is if you can't do one element, do everything else around it. Don't lose out on marks. You'll be building up marks to go along. Don't just assume just because you can't do one, you can't do any. Right? Leave the harder ones till the end and come back to them. Now we left the hardest one till the end. This is a redeemable debenture. Now because it's redeemable, you have to use the IRR method. So you have to run an IRR to figure out what is the true cost of this. So first thing we need to look at the cash flows. So year 0, your outflow is the market value currently is 89. So you have a minus 89 put in there. So if you buy that today, it's 89. In years 1 to years 7, because remember it's redeemable, you're going to get 7.5, which is 7.5% times 100. Because the par value is 100. You're told that in the question. So each year that you own it, you get 7.5 in. And also in year 7, now this is unusual, it's going to be redeemed at 102. So it's redeemed at a premium. So you have to account for that in your IRR as well. So that's your cash flow table. And that's your starting point to do your IRR. So remember, this is the hardest one. You need to do out the calculation because it is redeemable. We need to know the true cost of that. Now there's one tricky adjustment you need to watch here. We need to adjust for tax. So you always adjust for tax as you go. You don't adjust at the very end. So when you're doing an IRR, the 89 stays the same, as does the 102. But what you're actually going to adjust here is it's going to be 7.5 times 1 minus the tax rate. So I know this is tricky, but this comes with practice. So you need to understand that is after tax cost of interest. So it's the €7.5 of interest for each bond times 1 minus t. So that is 6.375. And you'll notice here I'm not doing each year individually out. The examiner, because they're giving you 7 years, they expect you to figure out that's an annuity. You can do out each year individually if you wish, but it's going to waste a lot of time. What you're better to do is realize that's an annuity. I can use an Annuity Factor tables, which are given in the exam. So we now need to get the net present value at 2 different rates, hopefully to get a positive one and a negative one. So we're going to do 10% first, because that's my usual starting point. So we're going to get the present value of each of them. So I'll copy down these cash flows just to show what is the present value of each of these. All right. So there's a number of ways you can do it. We're just going to use the discount tables. So we're trying to get the present value of 10%. For this cash flow, it's already at its present value. The minus 89, it's in year 0. So there's no discounting there. The year 1 to 7, this is an annuity. It's a 7-year annuity at 10%. So if we go to our tables, you go to the annuity tables, 10% for 7 years is 4.868. 4.868. So that means the present value of that cash flow for 7 years is the cash flow times the annuity factor, which is 31. So you make sure you understand that. You can do 7 separate calculations if you wish. That's fine, but it's going to take you a long time. The examiner is getting at there, they're giving you 7 years to see, do you understand that's an annuity factor? And this one is a simple cash flow. You use the present value tables for that. It's a cash flow to be received in 7 years, and the discount rate is 10%. So the factor there is 0.513. And it's 102 times 0.513. So that gets you 52.33. So what we can see here is, if we get the net present value there, we're adding the 89 minus plus 31 plus 52. So it's a net present value of minus 54, or minus 5.6 should I say. So that's 10% has minus 5.6. So we know here at 10% it's a negative NPV, so we need to go lower. Right, so how low you go, some might go 5%. I know from the solution I'm just going to choose 8. If I was in the exam and I wasn't sure, I'd probably go with 5 to make sure I get a positive NPV. So remember, the discount rate and NPV are inversely related. The higher the NPV, the higher the discount rate, should I say, the lower the NPV. Therefore, if we want a positive NPV now, we need to go with a lower discount rate. The 89 is still the same. I'll just bring these out one. So the 89 still isn't discounted. The discount factor now of an annuity at 8% for 7 years is 5.206. So it's now 6.375 times 5.2. So all we're changing is the annuity factor. So you can see it's very quick. You don't have to do another 7 set of individual cash flows. You still come to the right answer, but you'll waste an awful lot of time, and you won't finish the full question or the full paper. Finally then, we need to know the present value of a simple cash flow in 7 years, which is our present value tables. 7 years at 8% is 0.583. So that is 102 times 0.583. And adding those up, adding minus 89 plus 33 plus 59 is 3.654. So thankfully now we have the two pairs. We have 8%, which we're going to call R1, rate 1, and NPV1, rate 2, and NPV2. And now what we're essentially trying to say is the discount rate that makes the present value equal to 0 is somewhere between 8 and 10%. And that IRR is we're going to use a formula. So the IRR formula you're given in your table. So IRR you're told here, it's NPV1. So we'll just put this NPV1, 3.654 times 10% minus 8. And that's divided by NPV1, 3.654. Watch it here, it's a minus 5.641. So the thing you need to watch there about the minus, that becomes a plus. So on the top, it's 3.654 times 2%. And on the bottom, it's 3.654 plus 5.641. Because when you minus a minus, it becomes a plus. Right. So that's the fraction element of that. So if we do that calculation out, that gets us an answer of 0.073 divided by 9.295. So nearly 1%. And to that, we add, as per the formula, rate 1. We add 0.08. So our IRR is 0.08 plus 0.008. So it's 8.8%. So if you know IRR from the perspective of investment appraisal, you're using the exact same approach here. When you have redeemable debt, you need to use the IRR approach. Key thing is you need to adjust for tax, firstly, in your interest cash flows only. You don't adjust the initial or end cash flow. And then you need to run the numbers. And you need to know how to apply the formula to get, this is the after-tax cost of debt for that redeemable bond, or the redeemable debenture loan. So the 8.8% goes in as the cost, and that's already adjusted for tax. And the market value, we're told here, is 89 per 100 euro. So to get the market value, we take the book value, which is 600,000. We divide it by 100 to get the number of bonds, and we multiply by 89. We don't have to adjust for interest because we're told interest is fully paid up. That means the 89 is already ex interest. If it wasn't, we'd have to adjust for that. So the market value there is 534,000. And that's your first step always when you're calculating the WACC, is, to make this bigger, you get the three costs, or if you're depending on the number of sources, and you get the market values. To finish it then, what you need to do is you need to get the weight, because we need to get a weighted average. That's what WACC stands for. How we get the weight is we get what percentage of each of the market values. The total three market values added together is 3,080,000. So you might have a small bit of rounding. That is represented by, just show that, about 75-76% of that is ordinary shares. 534 over 3080 is about 17% is debenture loan, and 208 over the total, about 7%, or just under it, is for the irredeemable bond. So the key thing, the next step is get your weighting. The weighting is, that's why we get the market value. We need to use that to weight it. So what we're saying is 3/4 of our business is financed at 14%. Just under 1/5 of our business is financed at 8.8, and under 1/10 of our business, 6.8%, is financed at 7.7. And how we get the WACC then is we multiply the percentage. It's like an expected value. Weight by the cost, weight by the cost, and weight by the cost. And we add them up. So just format those a bit neater. So you're multiplying W times the cost. So 75% at 14, 17% at 8.8, 6% at 7.7. And adding those up gets your WACC. So it's a pretty straightforward approach if you know your steps. But where students fall down is they don't understand how to get each of the individual ones. This is where the little cheat sheet comes for. There's two ways to get your cost of equity. CAPM and dividend valuation model. Depending on whether it's a redeemable loan or irredeemable loan will dictate how you approach the calculation of the cost of debt. There's another one we haven't mentioned here at all, is your preference shares. So you need to be able to do those as well. So do out them individually first, and then your WACC is just 3 steps. Come up with the number of source of finance, fill in the numbers, and then get the weighting. That WACC is pretty straightforward if you know how to get those yellow boxes. Alright. So this screencast looked at Autumn 16 question 1, 13% of the paper that year, based on computational WACC question, an examiner favourite, particularly in the compulsory questions in recent years.